Imagining opening your laptop from a beachfront cafe and looking out over the Pacific waves of Surf City. You're answering client emails and checking your portfolio. But when you look at your potential tax bill, the number is 0. Not because you're using some kind of sketchy offshore loophole, but because the local tax laws were explicitly rewritten to invite you in. Welcome to El Salvador. Over the last few years, this country has completely transformed its global image, shifting from an overlooked Central American nation into a highly sophisticated technological hub. By embracing Bitcoin as a legal tender and also aggressively stripping away fiscal red tape, El Salvador has positioned itself now as one of the world's most premier destinations for digital nomads, crypto investors, and of course tech entrepreneurs. But behind the viral tweets and flashing Bitcoin city headlines lies a rigid territorial legal framework. If you want to build a bulletproof international tax strategy here, you need to understand exactly how the Salvadorian tax authorities draw the line between your global wealth and your local obligation. Welcome to Taxplained. Here I explain taxes so you can minimize your tax burden and maximize your freedom. Today we are breaking down the exact tax landscape of El Salvador, separating the political marketing from the actual tax law. The absolute biggest draw for international remote workers is El Salvador's strict adherence to a territorial tax system. Unlike most Western nations that tax your worldwide income, regardless of where you live, El Salvador operates on a more simple rule. They only levy income tax on revenues generated directly within their physical borders. Following major legislative overhauls, the government completely eliminated income taxes on all foreign-sourced revenue and international remittances. Let's look at how this plays out in real numbers. Say you are a remote consultant or software developer living full-time in El Salvador, but your clients are based entirely in the US and Europe. If you generate $100,000 in annual income from those four clients and have that money sent to your accounts, El Salvador taxes that revenue at exactly 0%. You do not pay a single cent of local income tax on that money because the economic activity occurred outside the local market. This gives location-independent professionals an incredible structural advantage over traditional jurisdictions. However, the moment your economic focus shifts inwards, you enter El Salvador's progressive tax system. If you start providing services to local Salvadorian businesses, or if you take a local salary, you are subject to the standard individual income tax brackets. Those brackets scale upwards quickly. Any local income under $6,600 a year is completely exempt. But once your local earnings cross that threshold, you face an upward scale. For example, if you earn roughly $24,400 locally, you pay a flat base fee of $720 plus a 20% tax on any amount exceeding that lower bracket limit. Anything you earn locally above $24,400 hits a maximum flat cap of 30%. Still better than Western European countries. El Salvador is a flawless sanctuary for foreign earned wealth, but it's a more expensive place to launch a purely domestic service business. For founders looking to establish an actual corporate entity or an operational startup base in Central America, the corporate tax architecture requires a specific blueprint. Standard Salvadorian corporations face a split flat rate income tax system determined entirely by top-line gross revenue. Companies generating up to $150,000 a year pay a flat corporate tax rate of 25% on net profits. Any businesses clearing more than $150,000 a year automatically scale up to a 30% corporate tax rate. While those baseline percentages look comparable to traditional markets, El Salvador allows pretty comprehensive deductions for all necessary business overhead, including international operation costs, equipment, and payroll, which of course reduces your actual taxable income. Furthermore, when you decide to pay out those corporate profits to partners or shareholders, El Salvador applies a standard 5% withholding tax on dividend distributions. However, look out for the compliance trap here. If a corporate shareholder resides in a jurisdiction categorized locally as a tax haven, that dividend withholding tax instantly spikes at 25%. If you want to bypass these corporate rates entirely, the strategic move is to align with the law for promotion of innovation and technological manufacturing. Under this specialized tech framework, businesses engaged in advanced software design, artificial intelligence development, data analytics, and cybersecurity can secure a 100% income tax exemption for up to 15 years, alongside full exemptions from local municipal asset taxes. And of course, you cannot analyze El Salvador without addressing its absolute exemption on digital assets. Because Bitcoin is recognized as official legal tender, the tax code treats it with unmatched leniency. If you're an investor holding digital currency, any and every capital gains derived from the appreciation of a Bitcoin are hit with an exact 0% corporate tax rate for individuals. You can buy, hold, and trade the asset without triggering a 10% capital gains liability, which does apply to standard real estate or traditional stock liquidations. But of course, do not confuse a 0% income and crypto environment with a zero-cost lifestyle. El Salvador relies heavily on its value-added tax, or VAT, to fund public infrastructure. A flat 13% VAT is automatically tagged onto almost every consumer transaction in the country. Whether you are paying a local hotel bill in El Zonte, buying groceries in San Salvador, or purchasing electronic hardware for your office, you will pay that 13% premium at checkout. Again, still lower than most EU countries. When you tally up the balance sheet, El Salvador's tax strategy becomes incredibly obvious. It's not a standard old-school tax haven designed for hiding strategic assets. It's an active and modern platform built to attract highly mobile global talent. If your business model revolves around high-margin digital creation, foreign-sourced remote employment, or cryptocurrency investment, this country offers an unmatched combination of legal tax elimination and modern lifestyle freedom. But if your business requires high local consumption, domestic client acquisition, or heavy physical logistics outside the free trade zone, the local corporate tax rate and 13% VAT will anchor your profits a bit. Before you change your residency or transfer your corporate capital, of course, execute a meticulous feasibility review, align your personal location, target market, and entity structure with the reality of the law. If you want to build a compliant, high-freedom roadmap for your international life, subscribe to Taxplained, and I will be seeing you in the next video.